When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be discussing current events, the markets, also some ways to structure income for retirement. We'll answer some listener questions for you. And then finally, the difference between an independent financial advisory firm such as Premier Retirement and the national chains. My name's Jeff Shade, and as always, just here to ask the questions for you, but the words of wisdom and solid advice, of course, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic now that we're on the radio together. Always glad to be with you every weekend, and of course, all the fine people here of the greater Tucson area. Before we get started with the radio program today, Jeff, I want to remind our listeners that if you hear anything in the program that piques your interest, you want to come in and sit down with Jeff and really just run some ideas by him or have him give you his ideas. We are offering the Premier Retirement Review, the roadmap, if you will, at no cost and no obligation. To get yours, 520-780-9059 is our telephone number. If you'd like to talk to Jeff about your journey towards a confident retirement, no cost, no obligation, 520-780-9059. Okay, Jeff, let's talk about current events. The market still seems to rip. Last week, we talked about it being overvalued for no explainable reason, but it just keeps on going. What is your feeling about the market for the remainder of the year, and do you still feel that it's overvalued at this point?
Well, I've been saying it's overvalued. Just because it's overvalued doesn't mean it can't go up. It just means it's super risky. And that's really where we're at. We have growth portfolios that we manage here that are very aggressive and are beating the market. But it doesn't mean you should just jump into them. It's been more lucky than good. Just because the market is so overvalued, it really has no justifiable upside other than the fact that there's a lot of rich people buying stock. It's interesting. We're seeing more insider trading. We're seeing Amazon. I heard Bezos is selling another $4.5 billion of his stock. We've got Palantir not too long ago said he's going to sell a bunch of his stock. We've got all the big CEOs of banks, and the banks are dumping stock. That's not usually a good sign if they're taking profits. Yeah, maybe they just want to go buy a yacht with cash and don't want to take a loan out like most people do, but they'd rather pay capital gains taxes on all that money. That just rings a bad bell to me. So it's not just me who's seeing it. Even the insiders are. Yet, at the same time, where are people going to put money? The interest rates continue to go up, which means bond prices continue to go down. Typically, that's a hedge where people like to sit and make a little bit money on the side. When the markets tank, bonds usually go up, but that's not been the case. So people are scared to go into the bond market. Countries selling the bonds, making them go down, which actually increases interest rates, especially long-term interest rates, which typically is not good for the market. That's usually a negative. We haven't seen GDP growth very robust. We had really soft numbers come in on employment, job growth, wage growth, just about everything that supports the economy. Yet we hear on the news, oh, the economy's great. Look how great it's doing. Well, it's the market's back up to all-time highs, but it's still only up 6 or 7 from a year ago, and it's only up barely, but all year to date because the peaks were just right before the first of the year. So we're just barely got back to breaking even in the last 6 months or so, 6 or 7 months. And, is that really a robust market? Well, we can say we hit all-time highs. The thing that's really interesting is I believe there was only 22 stocks out of 500 in the S&P 500 that actually made all-time highs at the same time the stock market was making all-time highs. That's a very thin market. That's a very weak market, in my opinion. So yeah, it's overvalued and it's scary. It doesn't make a whole lot of sense. I guess if you can jump on those 22 stocks, you can probably hang with the market and beat it. We're looking for momentum plays, but those can also be sold off so fast that you can't get out in time before you lose 20 or 30%. And that's why, unless you've got long-term horizon, unless you've got money you can afford to stomach watching go up and down like a roller coaster and in a position where you could lose some money, you shouldn't be in the market with that money that you need to spend on living expenses or preserve for retirement, things like that. So again, my tune hasn't changed. I still think the market's overvalued. Doesn't mean you can't be in the market. Depends on your situation and depends on how much you want to risk. But you are risking your money when you go into the market, especially at these values.
520-780-9059 is our telephone number if you'd like to talk to Jeff about your journey towards a confident retirement. No cost, no obligation. 520-780-9059. Jeff, President Trump has repeated his demand for the Fed to cut interest rates on Monday of this past week, claiming that the U.S. should have the lowest in the world and save billions in government borrowing costs. Now, some people are linking the Fed to the mortgage interest rates, and they think that the Fed cutting interest rates is going to directly affect their mortgage rates and maybe boost the housing market. That's just not the case, is it?
No, it isn't the case. In fact, we didn't see it last year when they did a couple of rate reductions, small ones, but nevertheless rate reductions. The only thing the Fed does is the Fed funds rate is all that they manipulate. Now, they could manipulate, or they could actually try to create longer-term bond interest rates by issuing bonds, selling bonds, or buying bonds. Now, if they want to buy bonds and are willing to overpay for bonds, they can drive interest rates down. The thing is there's really no more money left in the Fed. The Fed's been broke for a long time. The Fed is banks, by the way. The Fed isn't a federal government agency, in case you're confused with the word Fed, as in federal government. The Fed it's a private enterprise that was started basically by the Davos Convention of Rule the World people, the Vanderbilts, Kennedys, those guys, a long time ago. And that was to basically control banking, control monetary supply, and basically make sure that their pockets were protected and padded any chance they got. And that's what the rich people did. They basically joined banks and this organization at the hip so they could have some non-political, kind of outside the realm of Washington way to manage economics, manage lending, basically manipulate the market and manipulate the economy. I mean, seriously, that's what it's been doing. We've also known that the Fed, who can get political at times, the Fed will receive a little bit of pressure from who's in the White House. Hey, let's lower interest rates, or hey, can we try to tighten monetary supply here? We've got some deals with foreign countries and we'd really not want them to buy so much of our bonds. So we want to do this, that, or the other. Now, what's happened over the last, 20 or 30 years, not quite that long, but since Obama especially, is we've been basically printing money. And printing money means just throwing money out there, buying bonds, basically driving the price of bonds up. I mean, you got to create the bond, then you buy the bonds and you sell the bonds. So it is printing money, but you also dictate the price of those bonds when you sell them into the market, as long as people are willing to pay the price. So in other words, if you sell a 1% bond at full value, let's say it only pays 1% like they did 5 or 6 years ago. Okay, you pay $1,000, you make 1%. Well, then people say, I don't want to make 1%. I want to make more. I'm only going to pay 90% of the value for that 10-year bond. So I make 2%. So I make the 1% coupon rate, plus I just got a discount of 10. So now I'm making 2%. Well, what if that bond 3-4 years later, when bond interest rates like now are 4 or 5%, let's just say 4%. Now you're buying that bond at 30% discount. You're buying it for 70% of $1,700. And so the bond prices go down, interest rates go up. So if you're going to buy a bond at par, which a bond price is $1,000, the only way you can compete with somebody willing to buy a bond for $70, you've got to pay 5 or 6% interest now on that bond for them to pay full price. So how does that happen? Well, the Fed goes, hey, we've got these bonds and we'll pay 7% coupon, give us some money. Well, if that's the case, then they basically just reset the interest rates for 7%. Now, they haven't been doing that for a long time. They've actually tried to go to the market and sell bonds that nobody wanted to buy. Instead, the rest of the world seems to be selling bonds. They want to sell our bonds and they're selling them cheap. So if now they bought those old bonds, maybe they're paying 3 or 4% par rate, which is the interest rate of the bond, the coupon rate, they're just dumping them in the market. Now, part of that is because they want to kind of fight the value of the dollar. They want to fight the U.S. for, talking about tariffs and other things. And the other thing is the American economy isn't quite as robust as it used to be. We had, was it Moody's or somebody that downgraded it to an A- or something like that? But there's rating agencies that are just right on the edge of downgrading our debt and saying, it's not really as strong as we thought because, the dollar isn't as strong as it used to be. Other countries are growing. They're also manipulating their currencies against ours, and they're dumping bonds. If they dump bonds, the price of bonds go down and the interest rates effectively go up. That's on anything longer than a couple of years, 2 years, 10-year bonds, 20-year bonds, 30-year bonds. Those things are going up. The values, if you look at a bond chart, look at TLT, that's a 20-year bond. Look at AGG, that's the aggregate bond market. Look at GOVZ, that's a 30-year bond, I believe, or 25. Those ETFs that hold those bonds have gone down 25 and 30%, even more in the last few years because of interest rates going up. And if that's what the market bears, the market is going to dictate what a bank will charge you for a mortgage. If the bank can go out and invest their own money and get 7% on bonds that are basically backed by the full faith of the government, and they know that the Fed's not going to let the banks go out of business, so they know it's pretty dang strong, why in the world would they loan you money for a house at 4% or 3% or 2%? So the idea is, yeah, we'd love 3% mortgages and 2% mortgages, but we've got to get it where, people are willing to only take 2 or 3% in American dollar interest because maybe the rest of the world and other countries aren't paying as much, or maybe they aren't as safe, so they have to pay a little bit more. But the trade-off isn't as good as it used to be. It used to be you can buy a European bond for 6 or 7%, but it was risky. You could buy an American bond for 2% and it had no risk. Well, now they're wondering about the risk and say, you know what? I'm going to buy that American bond. I want 6% on that one too, just like everybody else will pay. Because shoot, everybody's risky. Everybody's way in debt. Nobody's really managing their economy, or their governments aren't really good at managing business as we're seeing in the past few years. So, maybe we should be a little bit more cautious. And if we're going to take risk on a bond that might go down in value, then I at least want to get a good coupon rate, good return on my investment, and at least be able to hold it to maturity and know that I'm going to make a decent rate of return that may keep up with inflation, et cetera, et cetera. Speaking of inflation, inflation's another reason that the Fed Chair Powell is probably not going to be really anxious to lower interest rates. By the way, he's only lowering the Fed rate. He's only lowering the short-term interest rate, which is what the overnight rates are that banks can borrow from the Fed, and they can kind of manage their money on an overnight day-to-day basis. Short-term money market accounts, 1 to 3 month bonds. There's an ETF if you want to follow and just find out what the rate is. Basically the current rate, it's SGOV, it's short-term government bonds. And you can kind of watch the interest rates, and they hold out pretty close to whatever the Fed says the Fed funds rate is. And they don't go down in value, but that's the only thing that's going to change is how much I can borrow money for a few months. Is that going to change mortgages? No. Is it going to change a 5-year car lease or purchase payment? No. Is inflation going down enough to where we can lower interest rates and create that extra money supply momentum, M2 money supply that has been known to create inflation before? All that money printing is what created inflation. And now there's just too much of it out there. They're having a hard time tightening. And if they do tighten, the interest rates go up, but they can't loosen. Interest rates are supposed to go down. So they tightened, trying to take the money out of the economy and lower the inflation rate. Hasn't really done much for what consumers need to buy and what they need to borrow at. So it's a catch-22. I understand what Trump wants to do. He wants to lower interest rates on the long-term stuff. But if nobody out there wants to buy bonds and are willing to buy them cheaper than what they've been buying them, then how are we going to lower interest rates? It's the bond market, and it's the market that decides what the interest rates are, not so much the Fed just stating, we're going to just change the 20-year bond rate to X. Well, you got to find somebody willing to pay the price for that bond at X in order for it to really hold water. Because again, banks can invest their money in bonds, or they can invest it in your house by loaning it to you and getting a return on investment. Banks want to make a profit, and they're not going to make 2% on a mortgage unless the government wants to start subsidizing. What does that mean? They got to start printing money again, which also increases inflation. We've already seen inflation tick up. It was heading towards 2%, getting really close. And all of a sudden now it's back up around 3%. I don't blame Chairman Powell for holding pat on interest rates. He's not doing it to be vindictive to Trump. He's doing it because that's how the Fed works. Trump understands how the economics work. And boy, it'd be great to have interest rates go down, especially on the longer term interest rates that have to refinance our national debt. And that was the whole problem with creating all that debt in the first place. Now, most people, when they were creating that debt, says, yeah, but if we keep creating debt, we can keep driving the price of interest down to 1 or 2% or 0%. And then the debt service is going to be almost nothing. Who cares? We can have unlimited debt. We can have unlimited money supply. We can have unlimited money, unlimited economic growth, unlimited everything. Inflation's not going to be a problem until COVID hits, the world shuts down, and there's a certain limited supply of money, limited supply of goods and services. The supply chain gets interrupted, and all of a sudden only those who have money can buy stuff, and then it drives prices through the roof, and all of a sudden the inflation chicken comes home to roost. Then you want to fix it? Well, I'm sorry, the poor just got poorer, and they can't get richer because they can't afford stuff with high interest rates. The rich stay rich because they don't need interest to buy stuff. They've got money, and separation of the classes continues to get wider and wider, unfortunately. So I know what Trump wants to do. He's trying to solve the problems for the middle class that voted him in, that trusts him and that believes in him. I believe in him and I trust him, and I know that what he wants is the right thing. I just don't understand how he can expect the Fed to all of a sudden turn a switch on or off on interest rates when it really isn't the Fed that's dictating the value of a bond today. It's the entire world market, and there's trillions of bonds being traded worldwide, and everybody's got a different rating. Everybody's got a different interest rate, and people aren't willing to take 2% for bonds anymore. So there's a problem. We're in a big catch-22. And the biggest problem is, how are we going to service debt when that $7 or $8 trillion, I think it is this year, has to be refinanced, and we have to refinance at a 6 or 7% instead of 2 or 1, like we thought we were going to just a few years ago. So we're in a big mess. And I think when that finally comes to light, that and the tariffs and the fact that other countries don't want our bonds anymore, that's basically a recipe for a huge market sell-off, a huge recession. I don't know if I believe in Trump, but I don't know if he can be so smart, but there's just certain things you can't do when you got one of your hands tied behind your back, so to speak. So we'll see if we can get through this economically and logically. It seems like it's just a can getting kicked down the road or a rubber band that keeps stretching tighter and tighter and is going to eventually snap. And we're going to see what economists and statistics and cycles and smart people like Ray Dalio and Warren Buffett, who's getting into cash, and other people say the market can't sustain itself at this pace without earnings and economic support. And we're not getting that. And just because the Fed says interest rates are lower, that's not enough economic support to fix the market. I think it's just a Band-Aid that might buy us a little bit of time and isn't going to really have any long-term effect on us unless we get out of the trouble that we've already caused over the last couple of decades. And I think it's unfortunately probably not going to end pretty. And I don't say that to be a doom and gloom guy. I'm just saying we need to be cautious of corrections, resets, recessions, some of the things that can happen to markets that have happened in the past, that have happened to I go back to the Roman Empire. We're kind of getting crazy like that. All good things do come to an end. I hope America doesn't come to an end, but I think the crazy out of control stock market may, and we may have to have a reset in order to save the country and save capitalism and the free market system that we've grown to love that's built America. If we want that back, we're going to have to probably go through a little bit of pain before we get it fixed, because economics and politics have not met in the middle where they ought to, unfortunately. I think eventually the piper's got to be paid.
We're talking with Jeff Oden on Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about current events. Our phone number, 520-780-9059. If you'd like to come and sit down with Jeff, casual conversation, and get your retirement roadmap, no cost, no obligation. As I said, it's just a casual conversation between you and Jeff. Take a look at the plan that you've got right now. If you don't have a plan, certainly we can talk about building you a plan at no cost, no obligation for this consultation. 520-780-9059, and you can make that call right now. Jeff, let's talk about some of the common and uncommon ways to structure income in retirement. I think that most people are familiar with the common ways. Those would include income from annuities, lifetime income, income from rental real estate, covered calls, dividends such as dividend stocks, and income from the growth of your portfolio. Most of those strategies suggest that you set up the portfolio and let it ride. But what are some of the other uncommon ways that you can structure income in retirement?
Well, I think maybe we ought to just touch on a few uncommon ways to talk about the common ways. Let's just go back to the common ways. You mentioned just portfolio gains. There's a rule of thumb in the Wall Street world that says as long as you don't take more than 4% out, you probably won't run out of money in 25 years. I mean, you've got a inside the bell curve probability of not running out of money. And in some cases, you'll build great wealth depending on your timing of your retirement. You'd retire in a super down market where the values are really low comparative to long-term history. You might do very well and do better than the 4%. If you retire at the height of the market, you've got a better chance of running out of money even at that 4%. We know that if somebody retired in the year 2000, and I've said the story about, Norm 100 times on the show and in my book, and just about every time I talk, I remind people that timing is everything, and market risk is something that you don't want to involve in your income plan. And he had $1 million in 2000, the market crashed, and he was locking in losses for the next 3 years while he's pulling money out to live on. The rest of his portfolio never came back enough for him to live. He ran out of money in about 14 years instead of being able to live a nice 30 or 40 year retirement. So we have to be careful about the traditional ways of just living on a stock and bond portfolio. What gets you to retirement is not the same strategies that get you through retirement. And some people just say, oh, well, I'll just focus more on bonds then. Well, shoot, 5 years ago, bonds might have paid 2%. And now that the inflation has happened or cost of living has gone up, you need a little bit more than the 2% on your let's just say $1 million portfolio. You need more than that $20,000 a year to live on. Maybe you need 40. Guess what? Those coupon rates on 2% on those bonds aren't cutting it. So you have to liquidate some bonds. Well, guess what? That 2% bond is down 25 or 30% from where it was a few years ago. So if you have a $1,000 bond, you paid $1,000 for that bond in your portfolio. Basically, your $1 million portfolio is only worth about $700,000 right now. So every time you take out $40,000, you're not just taking out interest that you're not going to get in the future. You're having to dive into your principal. You do that for a few more years, pretty soon you only have half the money you started with, and it's not sustainable. So just moving from stocks, which are typically more risky and volatile, to the bond market doesn't necessarily mean it's less volatile. unless you do some sort of a laddering strategy. And again, that's going to be very low income generating. So again, the 4% rule, if you can live on 4% of your investments, stay with it and hope that the scenario still holds out. I think it's very risky at this point to try to do that. So a lot of people do what you mentioned, annuities. Social Security is an annuity. Your pension is an annuity. You could take, and I'll just keep using that round number, $1 million. You might have 100,000, you might have 100 million, just add a zero, take zeros off, whatever. So say you have the $1 million and you say, well, I don't want to only make 4%. I need a little bit more than that. I can put, let's say, half of that in an annuity. Let's say I put $500,000 in an annuity called an immediate annuity that just pays me until I die, or pays me and my wife till I die, or pays me and my wife at least 10 years or till we die. And maybe the payout is 7% payout. Well, that's guaranteeing that you no longer get that $500,000 when you die, unless you die within the 10-year period, then you get at least 10-year payout, which means you get $350,000 of your $500,000 out if you both died before the 10 years is up. If you continue to live, you may get more than the $500,000 and it would continue to pay out $35,000 a year. That's at a 7% payout, which is a very common payout for a typical retiree nowadays. So in their mid to late 60s. But it's no longer your money. You don't get the balance of the account when you die, but again, it'll pay $35,000. Well, half your money just got you 85 to 90% of what you were trying to get out of the 4% rule with the whole $1 million in a stock and bond portfolio. Now you only need to take 1% out of your 500,000 remaining in order to make ends meet. That's a much stronger plan than doing a stock and bond portfolio at 4%, don't you think? I mean, half your money in an annuity, you're going to be out the half, but shoot, that other half, if you're only taking 1% out, I just can't see a scenario where you haven't doubled or tripled that money in the market or even in a stock and bond account if you're only tapping it for 1%, because you'll never be drawing into principal if even some of your money is in a bond, even a low interest bond. So let's step it up even a little higher. What if you could do an annuity that paid you $40,000 on $500,000 and gave you a total income account? And if you died anytime, the balance of the account goes to your heirs. If you need to tap it for long-term care or terminal illness before you die, you can cash in the balance rather than just taking income for the rest of your life. There's annuities that leave the balance in your control, but give you an income payout that is very similar, or even in many cases more than an immediate annuity, which is the old traditional annuity where you basically give the balance up to the company and hope you live long enough to collect your money. The other thing that's nice about those annuities, I say that because you said, let's talk about some uncommon ways to get income. Most people might get offered one of these annuities through Vanguard or Fidelity or some of their 401k plans that have some sort of connection with an annuity company. So they make that safe income and you think you're all set. But there's different ways where you can continue to keep control of that money and continue to generate income and still get the balance of that account if you haven't spent it to your heirs. If you look at back-tested history, and obviously back-testing doesn't guarantee any future result, you could say, oh, well, the average over the last 10 years has been 6 or 8%, but the first year you have it only make zero. You go like, oh, this doesn't play out. Well, wait 10 years and just see how it plays out. But let's say it underperforms. Guess what? You still get the income. Those things have a tendency to overperform in many cases. Indexed annuities, not just indexed to the S&P 500, but other indexes as well, can generate double-digit returns over time, which is better than a stock and bond portfolio as averaged over history. So there's a chance that not only will your income stay the same regardless, even if the account runs out, but if the account continues to grow, then your income grows. So those are some kind of unconventional ways to look at annuities in retirement. And there's one that I really like that's kind of out of the picture, not included in income planning very often, and that is the LIRP, the life insurance retirement plan, which is a tax advantage version of an annuity where you can take monthly incomes, but instead of taking a monthly guaranteed income, you take a predictable income, but you actually borrow against the future death benefit, which is going to be paid out upon your death, tax-free. Well, guess what? The insurance company knows they're going to have to pay that claim out when you die. But if you want to, they'll give you some of that payout early. You can spend it and they'll just take a loan out. They'll just give you a loan, charge you some interest against your future death benefit. So if you have cash value, you've overfunded it with a bunch of cash value, you stuff a bunch of cash in this tax-free life insurance policy, which is kind of like a tax-free bank. The interest that you grow on your cash value is typically similar or greater than the interest you pay on a loan. Now, you're not going to borrow everything you put into this account. You're going to borrow a piece of it here and there. So the interest that you pay on your accumulating loans continues to compound because you never actually take the money out of the account. It continues to compound in the life insurance, tax-free life insurance bank, so to speak, the LIRP, and continues to grow. And it'll eventually push your death benefit up higher and higher so you can borrow more and more.
Uncommon ways to structure income in retirement. That's what we're talking about with Jeff Hogan of Premier Retirement Planning and Wealth Management right here in Tucson. If our conversation has piqued your interest, you'd like to explore some of these uncommon ways to structure income, we invite you to give us a call here, 520-780-9059. You can make that call right now to request your Premier Retirement Roadmap. No cost, no obligation, no judgment, just a casual conversation. 520-780-9059. Make that call today. And you can also find out more about us online and schedule your appointment at premret.com, premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we're going to be answering listener questions and what to do if you lose your job just before retirement, when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you for making us a part of your weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning here in Tucson, also with an office up in Mesa. Our phone number, 520-780-9059. That is the number that you can call right now to schedule a casual conversation with Jeff to talk about your retirement planning. Again, if you've got a plan from someplace else, you want a second look at that. If you don't have a plan, we can work on one of those for you, or we can simply just answer any questions that you might have as far as your journey towards confident retirement goes. Again, no cost for this, absolutely no obligation whatsoever. It's just a casual conversation. Once again, 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week and set up a time for you to talk to Jeff. All right, Jeff, let's get into listener questions for this week. Arnold is standing by. He's listening to us in Tucson today, and Arnold says, I'm 64 and planning to retire in 3 years. I have approximately $1.2 million in my 401k, some CDs, money markets, and stocks. Even though Trump's tax bill is being extended, I'm still worried about taxes once he's out of office. Do you have some suggestions as to how to structure retirement income to minimize taxes?
Of course I do. If you've been listening to the show a long time, you know that you're asking the right question at the right time to the right guy. First of all the money that you've put away in that 1.2 million, I assume none of that's in Roth. So you've taken the tax deductions along the way. That's great. I'm assuming that if we just use a typical average, somebody when they get to 65 probably has at least 10% in their 401k as their current income. So let's say you're making 120, 130 a year. If you're making more than that, then maybe you undersaved. If you're making less than that, you did really good. Good for you. But let's just say that's kind of an average that I see day to day. A person in that situation, by the time you write off some of the things that you have withheld at work right now and any tax deductions, and I'm assuming that's might be your total income. I don't know if you're married or file separately or singly, but let's say you're married and you're the single income earner. That'll put you in the 15%, which is now the 12% tax bracket. And if you were to do an aggressive reorganization of your 401k and IRA stuff, and by the way, the 1.2 million, I'm assuming is in 401k, CDs, money markets, and stocks. I assume that that's tax qualified. If you've got like half of that in a 401k and the rest is in after tax money, this whole question is going to be answered completely differently. But let's just say the 1.2 is qualified, going to be tax money later when you pull it out. You're right. They're knocking at the door of going from a 12 to a 22 tax bracket. And I might refrain from trying to do anything for 3 years. But after that, it might be smart for you to defer taking Social Security for a few years, live on some of this IRA and 401k money, and convert 120 or so a year for the next 5 or 6 years, assuming Trump's tax cuts will stay in effect at least 5 more years and at least a year later before any administration that comes in mind could change it and actually make it go into effect. I can't imagine they'd do it retroactively. Honestly, I don't imagine that it would be an easy thing for somebody to come in and do right away, just because too many people are enjoying these lower tax brackets and doing some planning. So let's just say you have 5 or 6 years left, 3 years of work, maybe 3 years. You'd have to be pretty aggressive. So maybe you decide you want to pull some money out at 22% now, do a real aggressive plan to maximize that 22 bracket for the 3 years between 67 and 70, and then still have some non-qualified taxable money. Let's say you get your Social Security, you've converted, let's say half of the 1.2 million by the time you get to be 73 and have to pull money out. You've taken Social Security. I assume you don't have a pension. By that time, you'll be able to take about, I'm thinking somewhere between probably $50,000 a year in guaranteed income on top of your, let's say, $40,000 a year, $50,000 a year in Social Security. There's about 100, and that could be taxable. So you'd still be in that 12 or 15 or lower bracket. And then if you could convert the rest into Roths or LERPs, another $600,000, that would generate another, let's say, $40,000 potentially a year in tax-free income. So I could see you living, if you did this right in a tax-efficient way, somewhere in the neighborhood of the 120 you're making, only being able to spend the whole amount. Again, I'm just making assumptions here. I don't know what you're making, but let's say 120,000 a year would probably be a reasonable expectations on where you are right now. If you can continue saving like you're saving and do some aggressive conversions between the work years and the RMD years and do some slightly modified, maybe a little more conservative tax planning right now. So again, we have to dial down in your exact math, what you can do for tax deductions, whether or not you're taking the standard deduction or whether or not you have other things you could write off. Maybe you've got some real estate portfolio someplace. I don't know. You didn't mention it, but the whole picture would make me be in a better position to, give you a final plan, obviously, but you're thinking the right direction. I don't think the tax cuts are going to last forever. Most politicians do math in a non-economic way. They do it more in the politician way, money in, money out. And they don't understand that if you save people taxes, they'll actually spend the money. Other people will make money, they will spend money, and it actually creates more cash flow and more taxes overall if people are encouraged to spend money and build the economy. So yeah, there's some tax advantage ways you could structure this. I think you're thinking along the right lines, because otherwise you're going to be stuck in a 22 or 25% bracket or higher throughout retirement. Who knows if that bracket's even going to stay there? It may increase again with the new administrations going forward.
Arnold, we appreciate you listening to us in Tucson, and we will be sending you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is Steve listening to us in Rancho Vistoso. Steve writes, I'm 72. My wife is 70. We have a house worth $500,000 and $62,000 left on the mortgage at 3%. We'd like to do some traveling while we can, but realize that we don't have the money to take the kinds of trips that we want. Our kids are set and they don't need the house when we pass. I was thinking that maybe a reverse mortgage might be the answer. Can you explain how reverse mortgages work and the pros and cons?
Yeah, actually, Jordan in our Mesa office came from the mortgage industry, and he helps a lot of our clients get involved in reverse mortgages when need to, and even regular mortgages if they want to borrow against their house or have property issues. He's got a real estate background, which is nice. And so I've learned a lot from him in helping people. I used to just refer people out to a local agency here, and I was kind of always surprised at how high the fees were and how little they actually netted out. And then I found out through my son that, there's a couple of different levels of how some of these organizations get paid, and they don't have to get paid quite so exorbitantly from the banks and from the client with fees and so forth. They are regulated. There's only so much you can do, but we can still get them in a fairly favorable basis. One of the negatives of reverse mortgages, you have to go to a class, understand what's going on. You have to pay for an appraisal. The fees are a little bit high, and there's a reason for that. And that is that the government actually guarantees, and the banks need a little bit of protection. And so there's kind of a surcharge that you pay in order to make sure that, if there's any losses on the house in the future, that the taxpayer who subsidizes these plans are not left hanging. So there is kind of a little upfront hit. But again, if you're just going to die with the house, it may not end up being a bad thing anyway. You want to age in place, and there's probably still going to be some equity in there, no matter what the fees are, whether it's $10,000, $20,000 or whatever upfront to get involved. But the only time that those fees would actually hurt you is if you changed your mind 5 years down the road, wanted to sell it and go, oh man, I shouldn't have reverse mortgage. I just lost $20,000 or $30,000 of my equity, and dang it, shouldn't have done that. But guess what? There's a lot of ways to lose $20,000 or $30,000 in a lot of other stupid investments in other ways. I mean, buy an RV and drive that off the lot and watch yourself lose $100,000 in 5 minutes. So even the worst case in a reverse mortgage isn't always that bad. You can always sell your house. You just pay off what's owed, just like you'd have to pay off the $62,000 if you sold your house right now. If you were to start right now, and you're at the age where you probably ought to make this decision sooner rather than later, especially if that maybe $800 a month mortgage payment is kind of hitting you a little hard. You can't afford the trips you want, but if you could save $700 or $800 a month in mortgage payment, just that alone, just getting rid of that $62,000 would free up another $7,000 or $8,000 a year net to take trips with, right? Just that alone. You can do what's called a cash out reverse mortgage where they could just pay that off. Now, if you wanted to, at your age, you'd probably get somewhere around maybe half, let's just say $262,000 just to make the numbers easy. They would pay off the $62,000 left on your mortgage at 3%. They would give you another $200,000 that you could stick in the bank. Maybe you could stick it into an annuity that would guarantee income to take trips for the rest of your life. That you and your wife, let's see, if you did that, you'd get about, I don't know, probably another $1,500 a month. Plus you'd save somewhere between $500 and $1,000 on your mortgage. That would give you a cash flow increase of about $2,000 per month for the rest of your life. If you could handle that and have $20,000 extra to spend on living expenses, retiring on your terms, going on some trips, and even putting the leftovers away for a nice little nest egg should you need it at the end of your years, or just to pass on to your heirs because they're not going to get a whole lot of equity in the house, then that might work as well. But let's just go back, and you asked me how it works. So let's just say they give you a loan of $260,000 on a $500,000 house. And let's say between now and the time you pass away, the house doubles in value to $1 million. And let's say the loan that you took out tripled in value just because the interest rate's a little higher than, say, the appreciation of your home. Let's say you borrow at 7 and the appreciation on the home's 3 or 4. So your house doubles and the loan triples. So now you owe about $750,000 on the house when you die, but the house is worth $1 million. There's still $250,000 in equity. Well, if you take $250,000 out right now and you have $500,000 in equity in a house and you get hit by a bus, there's $250,000 in equity. Well, for the next 20 or 30 years, depending on how long you live, you could be getting that extra $2,000 a month to live on and have fun on. And guess what? When you die, there's still $250,000 of equity in your house, potentially. And that, again, these are just rough numbers and just an example. So I don't think the reverse mortgage has any negative connotations in situations like yours. The only time I think it has negative connotations, if you change your mind and want to move around and you keep on taking reverse mortgages out. You'd save money if you just took a regular mortgage out and paid less fees and didn't have to go through the rigmarole to get a reverse mortgage. But because there are goods, bads, and uglies about reverse mortgages, there's a lot of disclosures, there's a class you have to take, and there's some understanding involved there. But if you're interested in pursuing that, we can help you get through it, at least the dialogue and the discussion. I'd hook you up with Jordan and you could go down the road and see if it makes sense. But again, if you're in your 70s already and you're not able to take some trips, you're still in those go-go years, hopefully. Eventually it's going to get to the slow goes and the no-goes. And you don't want to be there when you finally decide to take a reverse mortgage out and then say, gosh, I wish we were in good enough shape to take trips. I would totally enjoy it right now, especially given the situation that you don't need to give your kids a house. All you need to do is know that it's yours till you die. You can age in place. You can even, with some of that money, you can even bring in home health care people instead of having to move to a nursing home or move to a facility to take care of yourself, assisted living or whatever. You can make your home that facility for yourselves with that extra money, perhaps. So again, those are my ins and outs of reverse mortgage. Not a bad idea for people in your situation.
And Steve, if you want to call us about that reverse mortgage, have a consultation. 520-780-9059 is our telephone number, and you can make that call right now. Thanks for listening. We'll send you out Jeff's book, Retirement: The Road Ahead. Next question is Victoria, listening to us in Green Valley. Victoria says, I'm 70 and I lost my husband of 40 years about 6 months ago. He handled all our finances. I'm lost and don't know where to turn. I now get a Social Security of $3,100 a month and a small pension of $1,200. He had a life insurance policy of $300,000. The house is paid for, but I'm worried about making it for another 15 years. I expect to live that long. I'm also worried about paying for a nursing home if I should need it. I'd like to have another income stream. Is it possible in this scenario? What do you suggest?
Well, anything's possible. You just have to plan the right way. If you need a little bit of help, we can make sure we take care of that. But 15 years, I don't know what your budget is. That wasn't really in the question, but with $3,100 a month, pension of $1,200, there's $5,300. That $300,000 of tax-free life insurance, let's say you put $200,000 of that in an income-producing annuity. At your age, it would be roughly $20,000 a year. There'd be another, let's say, $1,800 a month. Let's just say 17 for round figures. That puts us up to about $6,000 a month to spend and still $100,000 extra in a bank. Assume you own a house. That house can basically be your nursing home nest egg, whether you reverse mortgage it, like I mentioned in the last question, and use those funds to bring people in to take care of you in your surroundings on your terms, or you sell the house, take the equity, and move wherever you want. The equity in your home is probably more than enough to cover yourself in a typical nursing home stay. Most people don't stay decades in nursing homes. They stay 1 or 2 years. 3 is kind of max for the bell curve averages. There's only a small percentage of people stay longer than that. So I wouldn't really worry about that, especially if you have home equity. That is a cost, obviously, nobody likes to bear. It's not a cheap thing. But again, most people's equity in their home is more than enough to cover that. And consider also, you move to a nursing home right now. Let's say you had $6,000 a month coming in, and let's say you have a home. Even if you rented your home out for another $2,000, there's $8,000 a month, and then the extra $100,000 you have in investments plus whatever you save between now and then could give you another few thousand a month. You could have $10,000 or $12,000 a month for a year or two or more if you had to go to a place to convalesce in your final year. So I don't think you should be too worried. If you can live on the 6,000 range per month, you're okay. And I don't think you have to worry about long-term care. Now, if you have a lifestyle that, can't be handled on 6,000 a month, maybe we do the reverse mortgage now, get you some money out of there, or get you some cash flow that helps cover those bills. And if you're in really good health, maybe you buy a nursing home policy or something. I'm not really an advocate of nursing home policies. I'd rather see you do what's called asset-based long-term care, kind of like a LIRP, where you might put that $100,000 into a single premium or even a financed life insurance policy, so that when you die, at least your $100,000 becomes $250,000 when you die, or becomes $250,000 that you can use for a nursing home should you need to go there first. The nice part is in the asset-based long-term care, you'll get your money back one way or the other, rather than just pay for premiums, not use it, and end up seeing them gone and not being in your estate when you pass.
Victoria, thanks for listening to us there in Green Valley. Of course, you'll get Jeff's book, Retirement: The Road Ahead. And if you've got questions, 520-780-9059. You can also go to the website, primrat.com, and check us out there. Listening to Premier Retirement with Jeff Ogden, founder and president of Premier Retirement Planning and Wealth Management. Speaking of the website, it is primrat.com. And if you go there, there's all sorts of valuable information, including a resource page in which you can hear the radio show. We've also got some guides on there. It's just a great resource for you to check us out. Once again, it's primret.com, Premret.com. Once again, our phone number, 520-780-9059, if you'd like to request your casual conversation with Jeff. Jeff, let's continue our conversations here by talking about the difference between a national advisor chain, we all know who they are, and an independent firm such as Premier Retirement. So I'll start with the basics. What is the difference between an independent advisor, a financial advisor, and someone who works at a major bank, wirehouse, or one of the big box stores?
I mean, obviously the wirehouse, the people that you know, the Merrill Lynches, the Morgan Stanleys, the Chase, JP Morgans, Schwab, Fidelity, Vanguard. If you want to be a number, go there. If you want to have a bunch of stocks, bonds, and mutual funds to choose from, go there. If you want focused help, you probably have to have a lot of money to get that kind of focused help that you need in one of those big firms. Do you want to be with a firm that has brand recognition that everybody knows and feel like a number in a sea of millions and millions of clients? Or do you want to be part of a family where everybody knows their name? We know your lifestyle. We know your goals. We know your family. We know your needs on an individual basis. The other thing is that the wirehouses generally are told what to sell. I worked for a brokerage firm when I first got out of college, and every morning we got told what we had to sell that day. It wasn't about find out what your client needs and build a plan. It was find out who's going to buy this today and sell to keep your job. And I didn't like that philosophy or that theory, but I tend to think that it's still pretty prominent in the brokerage world today. Is they have their market makers. They have inventories of stocks, bonds, and other things that they have to sell in place. And they can bundle them up as if they're portfolios and that they manage a portfolio, and they'll take a fee and act like they're doing a whole lot of things for you. But it's really a firm that has kind of a dictated agenda or plan or script that, depending on your risk tolerance, fit maybe into 4 or 5 different buckets. And you pick the bucket that is most like you and you go with it. And it looks like it's being managed, but is really pretty much being dictated to you. In an advisory firm like ours, you get to be the boss. We work for you. We don't work for a firm. We are independent, so that you can dictate the agenda. If you come in and say, these are the things I want, my job as a fiduciary is to do my best ability to make sure that those needs and those goals are met with the right products that provide the tax savings you're looking for, the income guarantees, the growth prospects, the tax benefits, or the risk tolerance that you're able to withstand, and build a plan that something that we can review, take it, bite it off in year by year and see if we're on pace, make tweaks along the way. But based on what's important to you, not what's important to JP Morgan or Merrill Lynch / Bank of America or Schwab or whatever firm you work for. They've got an agenda. They're built with a board of directors and CEOs and people that have one goal, and that is maximize profits for their investors and their shareholders. It's not necessary to maximize profit for you. If they happen to do that, great. If they happen to do that, they'll have a better chance probably to make it for your shareholders. But our goal is different than some independent advisors. There's some independent advisors that are really good money managers. They're totally cool taking risks and throwing your money at the market and say, hey, we think we can beat the market. We're more hands-on, we'll be more tactical, and we don't take orders from a brokerage firm. And that might be what you're looking for. But honestly, in our firm, it's more of a comprehensive approach. We want to make sure that your life's work is preserved. So, we're not necessarily the independent firm for everyone, but we are an independent firm that really focuses on those people that want to save taxes, maximize income, worry less in retirement, take less risks if they don't want to risk, and be more proactive in protecting the assets rather than proactive in trying to chase gains that may or may not be there, or chase gains that could get you into trouble and lose some of your hard-earned assets when you're either too old or just too tired or just don't want to go back to work. And we hope we can help people retire and stay retired with a little bit of peace of mind and confidence in their retirement. Not, hey, well, you got here, let's just see what we can do. And if it doesn't work out, well, I know you'll probably be unhappy and go find another advisor or just go off and live on nothing if we run out of money. But those aren't the stories I want to be a part of. I want to be a party of those stories that 20 years down the road say, you know what, I never really had to take risks, but we've never missed a bill. We've been able to travel and do the things we wanted to do. Thanks for giving us a peace of mind to still have sanity in our 90s rather than have squandered our brain power by watching the market go up and down and risking our money and stress out for the last couple of decades in retirement. So everybody's got kind of a different focus, but the independent advisor can speak to more of a personal focus. And that's why we call Premier more like the Premier family rather than the Premier big group of how many advisors or how many clients can we get and how much money can we manage and look at our numbers. Boy, aren't we great? We just want to be great on a one-on-one basis with our clients. I'm very old school in that way. I love meeting clients face to face. I don't think I'll ever be able to retire from the standpoint of just being gone. I have to come back and see those members of what I consider our Premier family, just see how they're doing. It's a concern of mine. I mean, we take that personally. It's a little bit different here than most. There's some people that are independent out there that just want to grow so big they can sell their firm for $100 million and retire and be rich and go off and live in Switzerland for the rest of or whatever. I don't really have any goals to do that. I'm doing just fine as it is, and we can all do fine together without those grand aspirations to be a big number building firm with bottom line goals. Our bottom line goal is how many happy clients can we make? How many tax dollars can we save those people that feel like we're their advisory family? In fact, I'll even say that it was funny because Shelley got invited to a party this last weekend. It was, I don't know, it's a swim pool party. And she asked, she says, well, how did I get invited? And they says, well, we were thinking about having a friends and family party. And they go, well, wait a minute, Premier's our family. Let's get Shelley. We know she lives close and she'll come over. And they're right. And, they also know that I go to Mesa on weekends to be with my family, so I couldn't go. So they called Shelley and said, hey, you want to come? And Monica decided to hang out and have a nice quiet weekend. But Shelley went and said she had a ball. And she says it was funny. And because people ask her, like, why did you come? I don't know. They think we're family. And I thought that was great. It was just kind of a reiteration of what I just said.
If you would like to see the difference between a firm such as Premier Retirement, some of the big box firms, we invite you to call us here, 520-780-9059. If you have a plan, investments from some of the big box firms, the banks or the wirehouses, bring them on over here. We'll take a look at them. No cost, no obligation for you. If they're okay, we'll tell you that. But if we think we can do better, we'll also tell you that. So once again, no cost, no obligation, no judgment. It's called the Retirement Roadmap, and it's from Premier Retirement. No cost to you and no obligation. 520-780-9059. You can also find out more about our firm and request your plan online at premret.com, PREMRET.com. Jeff, out of time for this week. Thank you so much for your time, but most importantly, as always, I want to thank the greatest listeners in the world for joining us, ours right here in Tucson. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.
Are you concerned a health crisis could become a wealth crisis for you in retirement? Well, you're not alone. But here's some good news. I'm Jeff Vogan from Premier Retirement Planning and Wealth Management, and for over 30 years, it's been my job as a financial advisor and fiduciary to manage investments and design tax-efficient plans to provide predictable cash flow and guaranteed retirement income for people just like you. If you're concerned about your level of market risk, your retirement savings, or if you feel you're paying too much in taxes, or if your current advisor isn't having these conversations, call us and request your complimentary Premier Retirement Roadmap. Now more than ever, you need a plan that can manage market volatility, utilize the most appropriate tools, and secure your financial future, reduce your taxes, and provide sustainable income in retirement. If you're unsure about your financial future or you just want a second opinion, call us now and get your no-cost, no-obligation Premier Retirement Roadmap at 520-780-9059. That's 520-780-9059. Or visit us online at premret.com.
Investment advisory services offered through Premier Wealth Advisors, LLC, and Arizona State Registered Investment Advisor.
Solid wealth management advice is more important today than ever. If you're unsure about your current risk level, if you haven't heard from your current financial advisor, if you feel your successful retirement is in jeopardy, call Jeff Vogan at Premier Wealth Advisors at 520-600-6363. You deserve a team by your side to help protect what you've saved. Call Jeff Vogan at Premier Wealth Advisors today at 520-600-6363. Securities offered through Premier Wealth Advisors, LLC, and Arizona State Registered Investment Advisor.